Well, the big budget event is out of the way. It seems like the markets did climb the wall of worry, but what's in store for the markets now? Let's find out. And I'm in conversation right now with Rahul Arora, who is the CEO of Nirmal Bang Institutional Equities. Thank you so much, Rahul, for taking time out. Let's just talk about what happened on the budget day, because it clearly seemed that it took everyone by surprise with the kind of increase that we saw in taxes, LTCG, short term, STT as well for derivatives. But while the markets plunged lower, they did recover, and with quite a bit of gusto. How did you read into that?
Thank you for having me on the show, Aman. Yes, it came as a surprise because no one was anticipating it. I think the revenue projections seemed very credible in the interim budget as well, when you were looking at projecting your tax revenues and other revenue receipts. But yeah, I think the one thing that the finance minister has tried to do, or is attempted to do, is curb speculation. And I think there has been a SEBI paper out recently talking about how risky it is to invest in FNO, and most of the people that invest in FNO actually make losses. So I think this is a deterrent in that direction. Also, if you're investing in capital markets, I think what she's telling you is do invest, but keep your horizon a little longer. I think where she's sort of done a counterbalancing act is she's allowed that exemption to move from 1 lakh to 1 lakh 25. So theoretically, if I was a retail investor and I made say 10 lakhs worth of long-term capital gains, earlier my exemption was still about 1 lakh. So I was paying about 10% on the remaining 9 lakhs, which was 90,000 rupees. Right now, I'm basically paying 12.5% on that excess amount, but then I have that 25,000 extra buffer. So I don't think up to 10 lakhs of profits is going to make that much of a difference. The issue is going to come above that. But as you rightly pointed out, Avan, I think we saw this in the day of the election results as well. The Nifty at the lowest point was down 2,000 points and it closed only 1,300 points lower. So you saw 700 point intraday recovery. What this is telling you is the liquidity gush is still so strong. That people are willing to buy every dip into the
and
market.
It's domestic retail investors that are propping this up.
Absolutely.
Right?
I think, you won't see institutional investors buying very aggressively at this price. Obviously, there are pockets of value, whether you look at pharma, IT, FMCG, and technically these were all under-owned, right? Even BFSI. The whole trade over the last 15 to 18 months, Avan, had moved into capital goods, industrials, defense. Basically, a lot of funds, as you would have seen, came out with manufacturing and defense funds. So the market got very frothy in those parts. But that's not to say that there is not value. I mean, there will always be stocks cheap at a 25,000 Nifty and expensive at an 8,000 Nifty. You just have to find the value. But it has surprised everyone. I think, you just go back to demonetization, right? The size of the mutual fund industry was 5 lakh crores. It's 60 lakh crores today, 12x in 8 years. It's quite a remarkable story. So I don't think we're ever, in the foreseeable future, ceteris paribus, I don't see getting a big correction in the market because these days, even if it falls 3-4%, it gets bought into. We've had 3 wars practically fought. We've seen crude misbehave and come back. And you have to give credit to India. Our growth rates are stable. The RBI has managed inflation very well. Our external sector is doing well. Our rupee is stable. I think everything has been managed well in so much global uncertainty.
Yeah.
So someone would say, "Ab tak nahi gira, to ab kyun girega?"
Yeah, I was just going to say, if we manage to, like you say, stand tall within all of these adversities. So even you're saying, for instance, the kind of, if there were to be a global market correction that would play out, it would just be a bump along the road, but smooth sailing?
I think so. I think, so let's put numbers to this instead of talking rhetoric, right? So I think if you look at the size of the mutual fund industry today, I think about 30 lakh crores would be equity of the total mutual fund industry. I think if you take on average 3% cash also on that, you're talking, and this is just mutual funds. I'm not talking about insurance companies, AIFs, PMSs. You're probably looking at 1.5 to 2 lakh crores of liquidity just on the sidelines waiting to buy any dip. Yeah. And that, therefore, any correction that you get into a stock, people are not waiting for those 20-30% corrections. I mean 5-10%, and they're lapping it up. It's the fear of underperformance, and it has also changed after a lot of mutual fund regulations where fund managers, CTCs, now up to a percentage are locked into their fund. So performance is very important. So you're sort of in a way forced them to go quarter se quarter tak as well, and you can't really underperform. So chasing momentum.
Yeah.
But with these kind of numbers on the sideline, I'd be very surprised given the way the world is today, that we even get a 10-15% correction. It would really surprise me. It's warranted.
Yeah.
But will it happen is another matter.
Okay, so I guess everyone's watching this and heaving a sigh of relief, given that you are pretty confident and you believe that the undertone of the market is looking positive. Let's talk individual budget announcements. Just if we could talk about the capex outlay, and that continued to remain at about 11 lakh crore rupees, and that you were talking about that continuity that has been maintained this time around as well. How are you reading into the capex-oriented sectors, infrastructure, real estate, etc.?
So I think she hasn't tinkered with the number that she had put out in the interim budget. I think that number pretty much stands. There was no way she was taking her foot off the pedal, because I think if you look at the first tenure of the NDA government, capex sort of expenditure grew at a CAGR of about 15-16%. That number in his second term dropped down to about 8-9%. Now, given you had 2 years of COVID in the middle, but still at that kind of growth rate, I wouldn't see her pushing back too much. The last 1 year leading up to the elections and the budget, the NHAI allotments have not been that good on road. And Mr. Gadkari has been a very strong proponent of, the kind of kilometers he's putting in a day. So I think a lot of focus could go back to road construction. I think there is a lot of effort being made on the port side as well. So I think you may see some movement there. But I think given the way she has rationalized duties in the budget, I think this may be a precursor to more PLI schemes coming through in the market. So she's trying to make the domestic industry that was not as competitive more competitive, and I think this may be a precursor to PLI. So this is a pocket of the market, I think, that we continue to do well from a growth perspective. But they say everything at a price. I mean, if this jacket costs 5,000, I may buy it. At 8,000, I may think. At 10,000, no matter how much I love it, I won't touch it. But I think that's just what it is. I think these companies will continue to grow, but I think we've borrowed future valuations to that extent that buying some of these becomes very difficult. So I still think it's going to be a very infrastructure manufacturing heavy sort of 5 years with a populist tilt, as you saw in the budget as well. There is that tinge of,
but that was expected.
So it's like the word namak dal diya, of populism in the larger scheme of things. But I think Modi identifies with manufacturing and infrastructure, so I don't see too much of a pullback on that.
And everyone's talking about how there's going to be the manufacturing renaissance playing out already that has started. You're talking about valuation, so I'll just come to the overall markets, because there's really two sides of looking at it. One, of course, we're propped up by domestic liquidity, but the other is that the valuations perhaps may not be justified. What's your view?
No, so as I said, I think at an aggregate level as well, I think if I look at the index, it is an overvalued market. There's no question about that. Capital goods, industrials, manufacturing, defense are very, very overvalued. I think in the last result season, which happened in the month of April and May, consumer companies started talking about green shoots in the rural economy. Now, this may also be because political parties were funding the rural economy in propping them up for the elections. So that may have been an aberration. But I think even if you look at this quarter's results that have come out so far, the likes of Lever, Nestle, there is nothing to write home in terms of volume growth yet.
Okay.
So would I be paying those kind of valuations for these stocks? I'm not so sure. IT is an interesting one, Avan, because I think the world was expecting the worst of the US economy for quite some time. I mean, it's remarkable to think that you had interest rates at 5.25, mortgage rates at 7.25, and housing sales at record. So, I mean, the kind of resilience that the US economy has shown, and this may actually have a bearing incrementally on foreign flows as well, because in about 4 months we go into a US election, which is probably going to be the most watched event of the year globally. Absolutely. And so I think a lot of people may want to view that market with some interest as well. His policies could dramatically change if Trump comes back. He's capitalist by nature. So he'll do everything.
The stock markets loved him.
Absolutely, because, the Republicans have a very large representation on Wall Street. I think if you look at the Democrats, their funding pretty much comes from the arms lobby and the defense sector. So, it's, I mean, if you go back in history and see under any Democratic president, you'll always find some unrest that has taken place. Bar, I think, 9/11 under George W. Bush, where a freak incident happened. But I think from a flows perspective, the US will challenge us incrementally. But I think there is a reasonable amount of value that's sort of emerging in IT, pharma, and FMCG. But and I think banks, I mean, HDFC Bank still trading at 2.2, 2.3 times.
So you believe that some of the large cap banks, even some of the slow movers, because we have seen that sector starting to perform after a bit of a lull. So there is potential in banks.
I think so. I think there will be some short-term margin pressures because I think you're seeing the fight for deposits continue. I think banks are still raising deposit rates.
Yeah.
You saw the largest bank in the country do so not too long ago. But I think investors will see through that. I think most guys are already valuing their companies on FY25, and some have already gone into Q1 of 27. So if you're taking that kind of a view, State Bank of India is still trading at about 1.3, 1.4, maybe 1.5, depending on where your estimates are. HDFC Bank at about 2.2, 2.3 times, IndusInd Bank at 1.5 times. I think these are great investments. I mean, you still have almost 35-40% of your index as BFSI. So once every sector churn is done, the elephant in the room will come back to downside. I don't think the Nifty can go substantially higher from
without
here.
Support from
without, because I think Reliance has moved, ITC has moved, Larsen has moved, and you've done a fair bit of sector rotation in the other sectors. I think it's just a matter of time before the banking sector, explodes. The only question is what is the Nifty level at the time it explodes. But I think that provides a huge cushion. If there is even a correction and people come in and buy banks aggressively, it will provide a huge support to the market.
Okay, I'm going to wrap it up with the last two questions. I know you're getting very little sleep, and that's because of the research reports you guys have been churning out. So you're very closely associated with a lot of companies, mid, small caps, in-depth research. In light of this, share with us some interesting, would you like to, stock ideas, mid caps?
Well, I just mentioned a few from the BFSI space, which I think would make great long-term investments. In fact, a friend of mine was recently became a father, and he said, "Give me 3 stocks that I would buy for my daughter." And
there you go. That's the question.
Wedding, and I was like, "Banks khareed, bhai, banks khareed." But I think apart from that, Avan, we were discussing infrastructure. I think a second-order beneficiary could be cement.
But give me stocks.
Maybe I think Ramco. I think could be an interesting name. I think Ultratech's results were a bit disappointing. I think the market may move a little bit towards Ambuja, and I think if you're playing small caps, maybe a JK Lakshmi cement. We still like the consumer discretionary space selectively. We like names like United Breweries and Gillette. I think that space looks fairly interesting to us, and I think chemicals has seen a multi-year price and time correction. We've been very positive on the entire fluorination theme. So we played out SRF and Naveen, but I think from here, our analyst actually believes that oleochemicals could have, a good run from here over the next 2-3 years. So names like Galaxy Surfactants and Fine Organics sort of look interesting to us. So there are, and like I said, IT has positively surprised. So I think these are some names where if people want to enter into the market even today, I think there is certainly an opportunity. And life insurance, I think, the Prime Minister has spoken a lot about getting the public at large insured. I think what was very interesting was ICICI Pru Life's results this quarter. There was a huge valuation gap between ICICI Pru Life and the sector leader. That has sort of corrected itself a little bit because Pru Life has moved up about 5-10% post results, but that looks like an interesting space as well. So I think there are pockets of the market, like I said, even at this level, you will find ideas. Just be very prudent in terms of what your rational return expectations are, because people tend to forget that the Nifty was only 7,500 4 years back. From there, you've gone almost 3.5x to 25,000 in 4 years. So you have to moderate. If you have a heavy dinner, you do have to walk for a bit after that. So I think just these are good names that I have given. We firmly believe, we have well researched them. We are very confident, but just be a bit tempered with your return expectations.
And Rahul, you continue to remain very confident about the India story. And if you've said on record that if there's one stock you need to buy, it's the India stock. Mm-hmm. So where are we next 5 years? Do you want to hazard a guess in terms of levels that we could be at in the next election year, or just long term?
So I'll go back a few months when the state election results happened in December, and the BJP led alliances had won all, pretty much most of the states. I think the Nifty was around 18 or 19,000 then. I viewed it as a precursor to an NDA-led government in 2024, which is how it's panned out. Obviously, the absolute number for the BJP was a disappointment. But at that point, I had said that if you do have a BJP-led government, I would not be surprised if the index doubles over a 5-year period. So you were talking about an 19,000 Nifty. So you're talking about maybe somewhere between 35 to 40,000 at the end of 5 years. We've already covered a lot of ground. We're sitting at practically 25. So you have just another 15 to go, so to speak. So that's about 60% in 5 years, or 10-12% compounded. I don't think that's out of bounds, so to speak. So I think if nothing goes wrong globally, if we don't have, if Iran does not become the centrifugal force of a global geopolitical crisis, I think the world will be relatively okay. And I think if nothing goes wrong in India, we're entering a rate cut cycle. That's another very good sign. I think, interest costs will come down. Post-COVID, balance sheets were in very good shape for corporate India. So I think I maintain that view, no reason to change it. But like I said, I don't think we're going to, have exponential growth. Don't expect the Nifty to be up 25-30%. But I think between 10 to 15% CAGR. You will have down years. You will certainly have down years. But I'm saying a 10 to 15% CAGR. So you could have a year where the Nifty is up, say 30% in this 5-year period, and the next year where it's down 10-15%. So, but I think over a 5-year period, a 10-15% CAGR is reasonable.
Chalo, let's hope that gives you a good night's sleep then, because that's what you need. Thank you so much, Rahul, for chatting with us.
Thank you for having me on the show.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from Nirmal Bang.